Hi, this is Randy Finney with Right Side of the Chart, and this is a quick pre-Fed update. We have the Fed announcement coming up here at 2 p.m. Eastern Time today. It's 1:13 right now, so we've got about another 45 minutes. Then you're going to have Powell parade out in front of the media and start talking. That's going to also move the markets. That starts at 2:30, and boy, I'll tell you, I wish I had a very strong conviction or a stronger conviction on which way this thing's going to break. Honestly, I can make just a bang up case either way, and as such, therefore, to me at least, no reason to bet it hard. There's no reason to have a heavy long or short position. If you're a gambler or you feel confident, then sure, absolutely. As I said, I'm going to just recap what I'm seeing here, and again, this is nothing I haven't sent out recently. So you had a beautiful textbook bearish rising wedge patterns on both the small caps, the IWM, Russell 2000, as well as the SPY, S&P 500, which we're looking at here. Broke down today, even after a little flagging type action. You can see that below there. We really we broke down yesterday. We had that red candle through there and then followed through today. But again, you have to take this, at least I do, with a big grain of salt. Any breakouts, bullish or bearish, that occur right before a big potentially market moving event like the Fed announcement, especially this one, has certainly has the ability to either foil this, meaning it'll be a false breakout, we pop up, or build on it. One thing I can say with confidence is I don't think we're going to trade around in this area for a long time. We may see some whipsaw one way or another after the Fed, and then the market may pick its final direction starting tomorrow, possibly, maybe even next week. But we're probably going to have a pretty good move here. And let me just recap what I've seen recently. So, pointed out, we had positive divergences, aka bullish divergences, leading up to the recent low. Not only that, that was especially in the Nasdaq 100 a whipsaw, called a bear trap, a false breakdown. The Nasdaq took out its previous lows. We were already below the June lows on the SPY. And then more recently culminated with a rally into that divergent high. There's also a bunch of key Fibonacci levels there. There's the previous reaction high right there from the middle of August. Perfect to the button retracement there. There's actually it's a fib cluster. We've got a couple fibs there. Same with the small caps. I already went over that the other day. We had a cluster of key Fibonacci retracement levels. Somewhere I had it disappeared on IWM as well, and we're in that area there. And more importantly, you had the wedges as well in IWM, and you also had, just like everything else, divergent lows at the bottom. So it's been back forth, and these are my swing trading time frames. You get the divergent low, it's usually good for a rally. Divergent high. This was a pretty impulsive breakdown on IWM, the small caps, and it came with the negative divergence. But let me show you something else here. First, let me just show you, this is what it looks like on the weekly chart. You have the 200-day moving averages, both the simple and the exponential coming in together recently, where that rally had stopped in the small caps, just like the previous rally was contained there, and the one before that, and the one before that. So every single, all the biggest bear market rallies, 1, 2, 3, 4, so far since the bear market stopped, capped there. And on a weekly, it's the 40-week moving average, of course, same as the 200-day on the daily chart, and that's where we capped the S&P 500. So the S&P 500 has quite a bit more to carry up to hit the 200. So that's still a potential bounce target if we go up after this meeting here. Nasdaq 100 also same thing. You can see right here. We peaked back in November. Then the S&P 500 and everything else, or the S&P, I should say, peaked in the beginning of the year, and then we had a lower high in QQQ. Then we've rallied back, and you've had a couple ops to short it at the 200-day / 40 weeks, and that still is somewhere where we'll likely get at minimum a reaction if we bounce to a tradable reaction off there. And the thing about these 200-day slash 40-week moving averages, it's not always a hard bump into it. It's more of an area or range. Sometimes it's a 200 simple moving average that I have in blue. Sometimes it's the exponential that I have in red, and sometimes you split the difference right there, right between the two. And then you also have that downtrend line there. You have it in the NASDAQ 100. You have a downtrend line in the S&P 500 off the highs right there. The S&P comes in a little above the 200 days. But here's something else to show you. It's just amazing how, honestly, it's to me uncanny how well this bear market so far has played out, like the last what I call the last real bear market, 2007 to 2009, up to this point. Markets both peaked around the same time, roughly, fourth quarter. Remember, the Nasdaq peaked back in November, and the S&P had made a slightly higher high, but in 2008 everything peaked back in October, so around the same time, and then about the same drop and the same rejection on the 200s. And at this point into it, after you had fallen about this far in time and about this far in percentage terms, you also had, just like now, positive divergence setting up. And it's also, you know me, I have a little technical term that I use, whether divergence is confirmed or potential, and it's still just potential, because I like to see a bullish PPO crossover after the second higher low. Remember, positive divergence is prices making a lower low. At the same time, your indicators down here, you have the PPO and RSI, and you can use a MACD if you don't have a PPO. It's very similar, but those need to be making higher lows. And so it's these two troughs. See, I always say this, since they're momentum indicators, if it was still heading down, it would still be confirmed divergence. I like to see the troughs put in and then to finalize at that bullish cross. So you can see right there, we zoom in real tight, the lines are pinching right now. They have not yet crossed, and quite often in a bear market, especially when you go to make a bullish PPO crossover, you get rejected on that PPO line. You never get it. Now let's look what happened back then. Again, 2008. Let me zoom all the way back here. We'll go far all the way back to last bear market, 07 to 08. And then I'm going to zoom in so you can see it in video land here. If I can grab it. Sometimes it's a little hard to grab this slider here. There it is. And we'll tighten up a little bit there. And guess what? You had, again, almost an identical move down, identical rejections off the 200-day slash 40-week moving averages. At that point in there, when we were down just about as much, you had positive divergence forming. But again, it was unconfirmed divergence. You can see right there, see that PPO looking like it was poised to cross over? You had a comparable rally in the S&P, and then boom, it got rejected, never got up. The divergences failed to play out for anything more than that minor bounce that they had, relatively minor, and then the big drop came. So, the setup is there. Certainly, if the market doesn't like, if Powell comes out talking tough again, trying to jawbone down inflation, remember, he's going to do what he's going to do today, and that the odds are a 75 basis point rate hike. I'd put a 0% probability. Anything more than that truly is zero, and that's rare in the markets. They hardly ever give that. Let me just be wrong on record if that happens, but you're not going to get 100 basis point. You're going to probably get the 75. And there's a slight chance that he could do 50 and talk tough going forward, but that's unlikely. But if he did, the market would probably explode to the upside. Again, so you're probably going to get the 75, and then it's about what he says. If he goes into, well, maybe we'll wait and see, because it takes a while for these rate hikes to take effect. If the market likes that, it's going to rally. And again, I can't say this enough. The initial reaction here could be, I'm talking what the market does after 2 p.m. and after the 2:30 speech up until, we'll give it around 3 o'clock. That could be the direction that lasts, and it may not. Quite often, at least that knee-jerk reaction that occurs at 2 p.m. Gets faded, meaning you have a quick pop, and then all of a sudden it gets reversed, or you have a quick drop, it gets reversed. But then even that reaction is often faded. Where am I going with that? The takeaway is, if you're running a tight stop, you're likely to have that stop popped. So it is a strategy. If you think you're going up, I'll tell you, it's worth a shot. Worst case scenario, you get stopped out, you can always re-enter. So where I'm going with that is, I'm going to talk to both bulls and bears right now. Let's say you are bearish. You think that after the Fed meeting, this market's going to go much lower. You can absolutely put a stop. Now, how much lower? If you think we're going to new lows, hit my next downside targets, which I still maintain, and then it's just a matter of are they going to be hit soon, or are they going to be hit much later, maybe months from now or sometime next year. If you believe we're going down, then I think a stop above the recent highs is reasonable. Remember, we have a downtrend line there in the futures on the S&P 500. It doesn't show as well here on this SPY chart, but the 60-minute chart, you're right at downtrend line resistance. That recent high got rejected. You're at price resistance. You're at Fibonacci resistance. So a stop somewhat above. Now, somewhat, well, here's how it works. The tighter your stop, the more likely you are to get cleared, have that stop picked or run on a little pop and drop. Okay, now the downside is the higher you go, less chance you're going to get pulled, shaken out on a whipsaw, but the bigger the loss you're going to incur, and that may be loss that sticks. We may just keep going up. So there's no one answer where to put your stop. Somewhat to me is a little bit above to at least allow that. And I also like to do, especially on a day like today, at least a 60-minute close, if not a daily close above that level. So if the bulls print a solid close above there today, especially if it's built upon tomorrow, then it's probably going to stick, but intraday we could pop there. And likewise, that's if you're bearish. If you're bullish, well, you've got pretty good support right here. This whole breakdown will probably prove to be a false breakdown. And then again, I like to watch the futures as well, trade the futures, and I'm going to show you ES real quick just to kind of recap. I know I've gotten these charts out to you today, but here it is. ES, that's a 10-minute chart. This is just showing that if the Fed wasn't here today, this would be a great little long setup. You can look for these divergent lows at support, and this is what the market's been doing. But the Fed is going to override, or has the potential to override, little developments on the 5 and 10-minute charts. So back here, there were a lot of trading ops, and many of them played out well. You see a little divergent high and a trend line break and sell signal and yada yada yada. Downtrend line right there, or a positive divergence, negative divergence there. You get the point. But that's not really what I wanted to show you. I did want to speak to that hey, be careful. The active trading worked well up until about yesterday. That's where I start to kind of step back and stop taking little 5-minute and 10-minute chart pattern breakouts for quick trades. This is the 60-minute chart of ES, the S&P 500 futures. There's your downtrend line. I've covered this quite a bit recently. We had a brief pop, proved to be a whipsaw, and again, we're getting close enough to the Fed that you would almost expect a breakout to fail. Likewise, this one may be a whipsaw too, but it is. I got that chart out to you this morning. It is a breakdown. It's a well-defined, very clean uptrend line, clean negative divergence. So far, these 60-minute charts have been a beautiful guide. It's my go-to swing trading time frame. Look for these divergent lows and these divergent highs, and that's where you capture these little, what I call micro trends within the larger trend. That's what swing trading's all about. It's like investing on fast forward, and then you can even go 3 times or 4 times fast forward when you step down. Instead of the 60-minute charts, you go down to the 15, 10, or 5-minute charts. All right, so those are the things I'm watching. And the RTY, showed you that as well. Same thing, RTY, you had a nice wedge there. Broke down today. There was a shorter term uptrend line there as well. That wedge broke down, and you're at support as well. And there's your next uptrend line that comes in on RTY, the small caps. So, one other thing, or I should say, most importantly, upside and downside targets. I'll just recap. I always have to remember from time to time there's new folks coming into the site, or those subscribers that may not be active all the time and come in. This is and has been since the beginning of the year, early on, right after or even before the market topped. I can't remember exactly when. My 4th and final target for what I call my near-term bear market target. Ultimately, I think this one probably gets taken out and we go much lower. But if we get a thrust down anytime soon, that comes in at 235. And as you can see, we checked off T1, T2, T3. T3 was really was hit back here when we had those mid-June lows, a major low. We reversed, went long, and I had more confidence then of a bounce than I do right now. However, Those are the potential divergences I just covered. You can see on QQQ. I covered it on SPY earlier on the weekly. You still don't have the bullish crossover. So if the market likes what Powell is selling today, then you probably rally up here. You have a downtrend line. You have the 200s. That would be a minimum target. And that would also set up a big, large falling wedge that could then go on to break out most likely after reaction around those levels. Otherwise, we just crap out. And if we do, maybe the divergences are still intact. What I mean by that, let's draw it out this way, turn off all those lines. That was the level. Really looking at those pre-COVID highs down there. That is not a straight line. Let me try this one more time with a straight line here if I can. There you go. And so maybe we get something like this, one final capitulation sell-off that may keep it, if it happens quick enough, it could keep these divergences intact. Hard to say, but that's a possibility. And it's not a be-all, end-all, but again, I've covered this many, many times in the past. There are certain indicators that that got very high, like the VIX and the put-to-call ratios and the bull-bear IIAA bull-bear survey that measured the spike in bearishness, but they did not hit my bear market extremes, and the VIX is one of those. In other words, I'll show you that, cover that here. This is where, turn on all my lines. This is where the last two real bear markets ended. Back in 2008, and a lot of folks want to call, and technically it was just very fast, the COVID 36% drop in the S&P 500, and that's where we went. So as I mentioned recently, we've been at resistance on the VIX, or we were recently pushing up to resistance, and we're not too far from it. So to see a breakout above that resistance around 37, that would most likely coincide with a flush down. And if you saw a big surge in the spike in the VIX up to around those levels, and you got down to those next targets on the weekly, that would be a good case for maybe a more lasting bottom, where I'd feel more comfortable putting a pretty good amount of 401k funds back in the equity market and all that. Right now, I'm going to segue over to the bond trade. I am still bullish with bonds. They've had a very strong positive correlation to the stock market all year, meaning going up and down with the stock market. That may not always be the case. That hasn't always been the case, and I've been using that as a pure play long, as well as a indirect hedge to shorts, because I think we may see a return to the bonds being a risk-off asset if the stocks go down again. By that I mean, we came up. Who in their right mind wanted to buy 30-year bonds locking in when the yields were around 1% and then when they're around 2%? But now we're above 4%, and so I think there are going to be a lot of institutions realizing, hey, we're in different times right now in the market. Earnings have been falling, earnings revisions, companies, big fangs are getting beat up. We're in a bear market, and so at some point these yields start to become attractive again to institutional investors, pension funds, and the likes. And so from the fundamental perspective, and of course technicals, TYX, this is the yield on the 30-year bond, and I've been covering this quite a bit. And so we go back here to the daily chart. This would be a buy signal. When the 30-year yield breaks this trend line, it'll probably take us down there. It looks like it's going to happen, so I still like bonds going into. I'm going to hold some, continue to hold. I told you just the other day, had been before I had 5, 10, and 30-year Treasury bond futures. Just me, I had traded the 5 recently in and out earlier this week because it was a nice setup, but I'm not holding that as a swing position. I am holding ZB and ZN, the 10 and the 30-year bond here, which is basically just TLT is your 30-year bond ETF. And as I've been harping on or saying now for actually months, a buy signal will come on a break of this downtrend line. So that's the same. Remember, this is the inverse to the trend line on TYX, which is the yield on the long bond. Okay, so TLT is the ETF that holds those long bonds. If you're an ETF trader, or you want to watch it, and a lot of eyes trade this. Even some institutions might even buy this instead of the futures, and so that's what we need here. And we'll see after the Fed. But as I like to say, resistance is resistance until unless taken out. So it's not a hard all-in moment until that gets clearly taken out, especially if it sticks into next week and it's not just some noise, pop up after the FOMC announcement, then followed by a rejection. There, you got to watch out for that. That's always a possibility. TNX 10-year yield, if the lines populate, there it is. That one already broke down. The yield broke down there, but it's waiting, it's hovering. It broke down, but it's not going anywhere. Why? Because its big brother, the long bond, has not triggered a comparable breakdown there. So IEF is your 10-year ETF, but it broke out too. So you're on, on buy signals there. You're on buy signals on the 5-year. FVX is the yield for the 5-year. That broke down below its trend line as well. And then IEI is the ETF for the 5, and that one broke out. So you have 2 of the 3. You have the shorter term, the 5 and the 10 years broken out. These are your likely targets, and then the 30-year just needs to join. And again, we could see that today, or if not, then maybe these prove to be false breakouts. Like I said, the case is pretty compelling technically. I already made the case fundamentally, and I do think that the Fed is going to pivot to one degree or another. In other words, just a little less hawkish than they've been, and that would likely be the catalyst for a nice rally in bonds there. So I still maintain that bonds have a better risk-reward profile in the market. Now, what that means is, if the Fed comes across as pretty darn dovish, stocks are going to rally, and they're probably going to rally, almost certainly going to rally more in percentage terms than the bonds. That's how it works. But with bonds, you have less inherent volatility. I take a larger position in bonds than I do in stocks, so I could make just as much money, or again, I have a little bit better comfort level. Bonds don't go to zero. Stocks can go to zero. Now, not saying that Apple and Microsoft and Amazon are going to go to zero, but their charts are pretty banged up lately, and just wanted to say that I'm overweight bonds, if that makes sense. And then I'll decide after today what kind of exposure I want on equities and how heavy, how strong my confidence is. And then again, if the Fed is perceived as pivoting even slightly, and that's what the market thinks, and you're going to see more downside in the dollar, that's what I favor. You have negative divergence on the dollar. You have positive divergence on the euro. Euro chart's been constructive. Dollar's been weak lately. And again, the euro is simply the inverse of the dollar because it's the largest component of the dollar index at over 57% weighting. So you had a divergent high, then you had a breakdown of that trend line. You hit the first support the other day, as pointed out, little flagging type action. So again, depending on what the Fed says today, that could give us a catalyst, and I think likely will. But I have to say this again. I say it over and over: support is support until it's broken. So I'm telling you where I think we'll probably go, but react otherwise. If the dollar wants to do this because Powell is just going to be stubbornly hawkish, then so be it. Then you have to react, and this is going to be bad for gold and silver. This would be good for gold and silver and the other dollar-sensitive assets. So, and then there's your levels. Watch, we could smash right through there depending on what they do. We could come all the way down here quickly. Ultimately, I think the dollar is coming back here, and if so, if we start to, and the way it works is, if and as each support level is taken out, you get a check mark, and that opens the door to the next support level. And if you got this a move in the dollar like this, and it wouldn't be straight down, you'd zigzag down in the coming weeks to months, that would almost certainly entail a nice rally in gold, silver, and the precious metal stocks, and so forth. All right, let me get the video out to you guys so there's enough time before the market opens. I'm sorry, no, the market's about to wake up, I should say. So am I, at 2 p.m. today. So I'll go ahead and wrap this up here, try to get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.